In 2008, they printed $4 trillion. In 2020, they printed $6 trillion. By 2026, they will print even more. Not because they want to, because they have to. Here is the simple math. The United States government collects money from taxes, income taxes, corporate taxes, gas taxes, all of it. That money pays for everything: the military, roads, Social Security, and most importantly, the interest on the national debt. Right now, the government collects about $5 trillion per year in taxes. But here is the problem. If a recession hits, that number drops fast. People lose jobs. They pay less income tax. Businesses earn less profit. They pay less corporate tax. The stock market crashes. Capital gains tax disappears. That is not a theory. That is history. In 2008, tax collections fell by 18%. In 1 year, the deficit went from $160 billion to over $1.4 trillion. Now look at 2020. Tax collections fell again. The government had to borrow $3 trillion just to stay afloat. And here is the part nobody tells you. When tax revenue falls, the government does not cut spending. It does the opposite. It spends more. Unemployment benefits, stimulus checks, bailouts, so you have less money coming in, and way more money going out. That is the doom loop. Less taxes means bigger deficits. Bigger deficits means more debt. More debt means higher interest payments. And right now, the government already pays $1 trillion per year just in interest. That brings us to the scary question. What happens when a recession hits and the government cannot borrow any more money? What happens when they cannot borrow any more? Here is the answer. The United States currently has $39 trillion in debt. Let me put that number in human terms. If you spent $1 every single second, it would take you over 1.2 million years to reach $39 trillion. But here is the real problem. It is not just the size of the debt. It is how fast it is growing. Every year, the government spends about $7 trillion. But they only collect $5 trillion in taxes. That is a $2 trillion deficit. Every single year. And that $2 trillion gets added to the debt. So the pile gets bigger, faster than ever before. Now watch what happens when you add a recession to this picture. Right now, debt to GDP is 122%. That means the debt is bigger than the entire economy. If a recession hits, the economy shrinks. GDP goes down. That same $39 trillion of debt suddenly becomes 140%, maybe 160% of GDP. Investors notice that. And when investors notice, they get nervous. Let me explain why investor nerves matter. The U.S. government does not have its own money. It borrows money by selling treasury bonds. Think of a treasury bond like an IOU. Someone gives the government money today. The government promises to pay it back later with interest. Investors buy these bonds because they think the U.S. government is safe. But if the debt keeps exploding and GDP keeps shrinking, safe starts to feel risky. And when something feels risky, investors demand higher interest rates. You would do the same thing. If a stranger asked to borrow $100, you might charge 5% interest. But if a different stranger has no job and no income, you might charge 25% interest. Same logic. Higher interest rates on government debt means higher interest rates on everything else. Mortgages, car loans, credit cards, business loans. So a recession hits. Tax revenue drops, debt explodes, investors get scared, interest rates rise, borrowing gets more expensive, the economy slows down even more. That is the negative feedback loop. And once it starts, it is almost impossible to stop. But here is the part that changes everything. The government has one way to break this loop, one move that destroys the rules of normal economics. And they have already used it twice in your lifetime. That move is called money printing, and it is the only card the government has left to play. Here is how it works. When the economy crashes and tax revenue disappears, the Federal Reserve does something strange. They create money out of nothing. Digital dollars. They use that money to buy government bonds. That pushes interest rates back down, and that money flows into the economy. In 2008, they did this. In 2020, they did it again. And both times it stopped the recession cold. Now here is the hard truth that most financial experts will not tell you. Money printing is not a fix. It is a trade. Think of it like medicine. A doctor tells you that you have a deadly disease. You will die in 2 weeks without treatment. But the treatment will destroy one of your organs. You will only live 5 more years instead of 50. Most people take the medicine. That is exactly where the U.S. government sits right now. Option A, do nothing. Let the recession happen. Tax revenue collapses. Debt to GDP hits 160%. Interest rates explode. The bond market crashes. And the country falls into a depression that could last a decade. Option B, print trillions of dollars, force interest rates down, prevent the immediate collapse, but cause high inflation that destroys the value of your savings. Which option do you think politicians choose? Remember, most politicians serve 2, 4, or 6-year terms. They do not care what happens in 10 years. They care about winning the next election. So they will always choose option B. They will print the money. They will kick the can down the road. And they will let the next group of politicians deal with the explosion. Inflation is the hidden tax. You do not see it on any bill. But every time they print money, the dollars in your bank account buy less. Your paycheck buys less. Your savings buy less. The government steals from you slowly, quietly, and legally. But here is the part that should scare you more than inflation. What if printing stops working? What if the next recession is so deep that even trillions of new dollars cannot fix it? The bond market has already started sending a warning signal, and that signal flashed red in 2023. The bond market never lies. Stocks can lie. Politicians can lie. News anchors can lie. But the bond market is just numbers. Cold, hard numbers. And in 2023, those numbers flashed red. Here is what happened. Normally, when the Federal Reserve hints at cutting interest rates, bond yields drop. Investors get happy. Prices go up. But in late 2023, the opposite happened. The Fed hinted at future cuts, and bond yields spiked higher. Investors were not buying the story anymore. That is the warning sign. It means the people who lend money to the U.S. government are getting nervous. They are demanding higher interest rates even when the Fed tries to push rates down. Now let me add one more layer to this. Deflation. You might think deflation is good. Prices go down. Gas gets cheaper. Food gets cheaper. Rent goes down. But deflation has a dark side that destroys economies faster than inflation. Here is why. Imagine you owe $300,000 on your house. You lose your job in a recession. Your income drops by 20%. But your debt stays exactly the same, $300,000. That debt just got harder to pay, much harder. The same thing happens to the government. If deflation hits, tax revenues fall, the dollar gets stronger, but the debt stays at $39 trillion. That $39 trillion suddenly feels heavier, much heavier. So the government faces a nightmare scenario. High inflation? Bad. People get angry about prices. Deflation? Even worse. People cannot pay their debts. Banks fail. Companies go bankrupt. Between the two, the government will always pick inflation. And that brings us back to printing. They will print trillions to prevent deflation. They will print trillions to keep interest rates from spiking. They will print trillions to keep the bond market from panicking. But here is the question that keeps economists up at night. How many trillions can they print before the whole system breaks? Japan tried this for 30 years. It did not end well. And the U.S. is following the exact same path. Japan tried this for 30 years. In the 1990s, Japan's stock market crashed. Their real estate collapsed. And their government did exactly what the U.S. is doing now. They printed money. They bought bonds. They pushed interest rates to zero, then below zero. Then they printed even more. And what happened? 30 years of nothing. Flat growth. Wasted decade after wasted decade. Their debt-to-GDP ratio climbed to over 250%. That is more than double where the U.S. sits right now. The United States is walking the same path, not because it is a good plan, because it is the only plan. Recession is not allowed. Deflation is not allowed. Bond market panic is not allowed. So they print. In 2008, they printed $4 trillion. In 2020, they printed $6 trillion. The next recession will be bigger than both of those. Much bigger. Because the debt is bigger, the deficits are bigger, and the room to maneuver is smaller. So here is where you sit right now. You can watch this happen like everyone else. You can let inflation eat your savings. You can let the government print away the value of your paycheck. Or you can see the game for what it is. The system is not broken. It is working exactly as designed. Print money. Kick the can. Let the next person deal with it. Politicians will be fine. They own gold. They own land. They own physical assets that printing cannot destroy. The question is not whether the government will print. They will. The question is what you do before they do. Because once the printer starts running at full speed, it is too late to get ready. The time to move is now. While everyone else still believes the economy is fine. Here is the reality they do not want you to figure out. The Federal Reserve has never successfully stopped a printing cycle once it started. Not once in history. Every time they try to stop, something breaks. And right now, something is already cracking in the bond market. You will not hear about it on the news, but you will feel it in your wallet. And that is the part of the story they hope you never connect.